the US versus Australia. We Australians like to think of this rivalry like a big brother versus little brother. But if we're being honest, most Americans probably see it like a human stepping on an ant. Regardless of the severity of this rivalry, or lack thereof, in this day and age, the everyday Australian investor has access to more investments than ever before. So with better access to international market, this begs the question, when thinking about investing in shares, should we be backing the ASX here in Australia, or should we be investing our money in the American economy? In today's video, we're going to discuss the factors you need to keep in mind when considering whether you want to invest in the Australian share market or the American share market. Now, I know you guys probably hear this all the time, but Alan and I are not financial advisors, nor is any of our content supposed to be taken as financial advice. I will also preface this video by letting you know that pretty much all of these points were things that I considered for my own personal portfolio, and so there may be a skew in the relevancy of these factors to people who fit my demographic. Just before we get into the bulk of the video, if you enjoy free content like this and you want to show a little bit of appreciation, all Alan and I ask is that you gently tap the like button, as it not only helps our videos get pushed through the almighty YouTube algorithm, but it also makes Alan and I feel loved as well. So now that that's out of the way, let's jump into it. So one of the first things that came up as a pretty notable difference between the two options when I first started my research was the fact that Australia has such a narrow economy, and not only that, but an even narrower share market. Meaning if you were to have a look at the top 20 or top 50 companies that are traded in Australia, you'll notice a lot of them are from the same sectors. When you compare that to the US share market, you'll notice that they do have a much wider variety of companies. Now, it definitely is important to consider that the majority of their positive growth over the last few decades has been mainly concentrated to the huge tech companies that are listed in the US markets. And as we've seen, especially in 2020, those big tech companies had a huge influence on what the market did overall, and pretty much carried the entire US share market through the worst months in the downturn that we saw earlier in 2020. Another point that's usually brought up when you're making decisions like this is how familiar you are with the companies that are actually traded on that share market. Now, in the past, as Australians, it's usually been pretty safe to go with the companies that are traded on the ASX. Those are companies that we interact with on a day-to-day basis, companies that are based here in Australia and that we use. However, due to globalization and just how massive these US companies are, I wouldn't be surprised if some Australians were more familiar with those companies traded in the US than they are with ones here in Australia. And it's not even just being familiar with them. Most of us probably use the products and services that these US companies produce more than we use the ones that are based here in Australia. Now, these next few points, in my opinion, are some of the most important to consider, yet in the other comparison videos I've seen, no one is mentioning them. And they have to do with the practicality of actually investing in Australia versus overseas. So the first thing to think about is fees. As some of you may be aware, each of the 4 big banks here in Australia actually offer a share trading service attached to their banking options. And opening an account with any one of these would allow you to buy shares here in Australia on the ASX, but they also offer international share trading. And although it is quite convenient for you to make these transactions, you definitely need to have a look at the fees that they charge when doing international trades. As you can see here, the brokerage fee, which is the fee that you pay anytime you buy or sell a share, is dramatically more expensive when you do it overseas. Now, this was something that was a barrier for me personally going ahead and investing overseas for such a long time, because when you're investing such little amounts, having a huge brokerage fee taken off straight in the beginning, it could mean that in order just to break even, you need to make upwards of 15%. But luckily, I was able to find a solution to this problem. It's a company called Stake. Long story short, Stake actually don't charge any brokerage fees whatsoever. And if you guys would like any more information on what Stake offer and how it works, I'll pop a link to our Stake playlist that we've made in the description below, or you can click this card. And if any of you guys find that stake would suit you as an investor, feel free to use the code down in the description below. That'll actually get you one of 3 free stocks. The most expensive one at the time of this recording is Nike, which is trading at about $140. So with fees taken into consideration, the next thing you need to think about is the currency risks. Basically, what this means is if you were to invest here in Australia and achieve a gain of 10%, you could liquidate that investment and you would have gained 10% of the Australian currency. That would buy everything that you normally buy here in Australia as a resident. However, if you were to make an investment overseas in the US, make a gain of 10%, if you were to liquidate and bring your money back to Australia, there would be an additional force in there that you would have to contest. And that would be the currency differences from when you sent your money over to the US compared to now when you're bringing it back. I think the easiest way to understand this is to have a look at this example. As you can see, the capital gain of this investment is 14.66%. However, because the exchange rate over the last year has gotten worse, you can see here that the currency gain is actually negative 11.18. So in the event I wanted to liquidate this hypothetical portfolio and then bring the funds back to Australia, my real return wouldn't be as high as I may have thought. Now, the important thing to keep in mind here is that if you do decide to invest internationally, not all brokers will tell you what your currency gain is as an Australian. So the website shown here, ShareSite, is the one I use to track my real return. Again, I won't go into too much detail here. You can have a look at this video if you wanted to know more about the benefits of ShareSite. But if you do decide ShareSite is a website you would find value from, you can create a free account with them today using the link below. And if you do decide that one of their premium plans is better suited to you, you can actually get 4 months entirely for free from any 12-month plan. Now, one last thing to consider with currency risks before we move on. As you may have seen on that example, that represented a 1-year time period. So for those of you who may be investing in the US and needing to bring back money fairly soon, the currency risks are definitely there. However, there have been studies that show if you are to invest overseas on a long period of time and adopt a strategy like mine, which is dollar cost averaging, there is evidence to show that that currency risk will eventually move towards zero. So in other words, it becomes less and less impactful the longer the time period. Now, another thing to consider is dividends. If you know anything about the ASX and Australian companies, you'll know that they love dividends. Australian companies are known for paying out a lot in dividends, and this is actually a factor which attracts a lot of investors to the Australian share market. Now, on the US side, most companies generally don't adopt as big a dividend payout as Australian companies do, as they usually prefer to invest more of their profits for potential growth in the future. But the important thing I wanted to bring up in regards to dividends is the fact that for any dividends you earn on US shares, you actually have to pay a 15% withholding tax. So that's just something that you need to consider. And the final point, the point that you've probably all been waiting for, is the differences in return. So depending on the article you read, there can be quite conflicting numbers. However, the general consensus is that the US market has far outperformed the Australian market, particularly in the last couple of decades. Now, as this article explains, if you were to reinvest the dividends that the Australian shares put out, it does decrease the difference, but the US still outperforms by a comfortable margin. To give you an idea of how this outperformance may actually impact an investment long term, let's look at a very simple example. If we take the example given by Rivkin in their article, which says that the outperformance could be as much as 4.6% each year, let's assume, for the sake of simplicity, that the Australian share market averages 5%. Now, it could do way more than that, it could do way less. This is just an example. If someone were to adopt a dollar cost averaging approach, investing into an index that mimicked the Australian share market, and they were to invest $600 a month for 40 years, this is what they would end with. From $288,000 invested, they would end up amassing $915,612. Now, if we keep that exact same example, except assume the outperformance mentioned in the article, which was 4.6%, bringing the hypothetical annualized return to 9.6%, you can see from the same $288,000 invested, you would end up with $3,361,503, which is an insane difference. Now, again, I'm not saying that this is what's going to happen and these are accurate numbers. This is purely an exercise. However, it's important to see how these numbers may actually impact you in case they turn out to be somewhat accurate. But again, this doesn't show you the entire picture. As we mentioned throughout the video, there are things like currency risks and fees, and probably many other things that weren't mentioned here that could impact your return. The ones mentioned today were just ones that I personally considered when thinking about my own personal investments. If you guys had any other factors that you thought needed to be included in this list, pop them down in the comment section below. I know that the other viewers would really appreciate it, along with myself. I'm an investor just like you, so anything that you can bring up that I haven't considered is a bonus for me as well. Other than that, if you guys do enjoy this sort of content, then definitely go down, hit the subscribe button, hit that notification bell, and that'll ensure that you're first to know when we post any new videos. But if you can't wait that long, this is a video that YouTube thinks you'll enjoy, and this is our latest video. Hopefully one of those appeal to you, but if not, I'll see you next time.